Hi, I'm Don Chamberlin. I'm a certified financial fiduciary, which means I am legally bound to act in your best interest. Over the past 2 decades, I've helped thousands of people plan and maximize their retirement income. The truth is, the best retirement income solution is a personalized one. It's designed for you and your life, nobody else's. Learn key strategies to avoid costly mistakes and secure your retirement savings. Ready to define your retirement dreams and make it happen? Let's build your dream retirement together here. So we're back again with Dave Alison. Dave, again, is the president and founding partner of C2P Enterprises, as well as the president of Prosperity Capital Advisors, a $4 billion RIA firm. Dave's also a certified financial planner, and he's an enrolled agent, so he can represent you in front of the IRS just like a CPA could. So welcome back again, Dave. We had a great podcast the last time, and this is number 2. We're going to go over this time your tax management journey, which is something that you created, and your roadmap that you put together for that. So in the roadmap, what we find is Dave's put together his knowledge of working with high net worth individuals in the tech industry in Silicon Valley, and there's actually 7 different phases of this. And we already talked a little bit about understanding the order of money, so maybe you can fill us in on the rest of the different phases.
Yeah, thanks, Don. I would love to. So, as you mentioned, we have understanding the order of money listed as the first, because I think it's the most important. It's the foundation, right? How you're accumulating money and in what types of accounts. Number 2 is measuring your bracket. And we alluded to this a little bit in understanding the order of money, because the United States tax system is a dynamic pay-as-you-go system. We all know the more money that you make, the more taxes that you pay, but it's not just the dollar amount. The more money that you make, the higher your marginal tax rate. And so there's all these planning strategies to think about in the brackets themselves. Don, you brought up a great example of bracket bumping Roth conversions. And essentially the simplicity behind that is if you have income and you're in the 12% bracket, you might want to accelerate a little bit more income by doing a Roth conversion to fill up the top of that 12% bracket. Because again, the tax system is a use it or lose it system. If you don't take advantage of that lower rate in that year, it's not like you can go back and try to reclaim it in a future year when you do need or have more income. So it's so important to measure your bracket each and every year, both your income as well as any capital gain, which is typically derived from investments that you might hold, because there's different brackets depending on if the income is coming from ordinary income or if it's coming from investment income like capital gains.
Right. So how do people measure their tax bracket that way, Dave?
Well, the easy solution, Don, is to work with an advisor that can help do it for them. But the reality of what we typically do from an advisor perspective is as the year goes on, we typically around October, November, December, start collecting all the sources of income that our clients have had.
Sure.
So if they're still working, we might request pay stubs. If they're retired, we're going to look at how much income we've drawn and out of what accounts. And we're going to do what's called a tax pro forma. We're going to basically run a mock tax return as if the year was over. And we're going to say, hey, here's where we feel the opportunities exist. Because the problem, and Don, I mean, I've learned so much about the tax business from you, but like the reality of the actual tax preparation side of the business is that most tax preparers are historians. They're looking backwards at what happened in the prior year, and there's nothing you can really do at that point. We want to spot these opportunities before the year closes out, because when the clock strikes midnight on December 31st, these opportunities could be gone forever.
That's right. So that's critical to any type of tax planning. is that you meet with someone before the end of the year, because your accountant's not going to be able to do anything for you if you say, I want to say taxes for last year when you're filing before April 15th of the following year.
Exactly. And that kind of, parlays right into the third stop on our roadmap in our journey, which is avoiding marginal tax traps. You know, these are what I call landmines in the tax code. And I'll give you an example. We talked in our last episode that the highest marginal rate today is 37%. That's the highest bracket is 37%. But the highest marginal rate in the tax code is almost 50%. And what I mean by that is if you took $10,000 out of your IRA, and let's say you're in a 22% bracket, how much tax would you expect to pay on that $10,000 withdrawal? Well, you'd expect to pay $2,200, right? 22%.
Right.
Yeah.
Right.
But what happens is the IRS is kind of sneaky. They have all these what I call stealth taxes in there. And one example of that is Social Security. You see, Social Security has its own category called provisional income. And although that $10,000 withdrawal might be taxed at a 22% rate, it could then have a counter effect in your tax return where it causes more tax on your Social Security benefit. And I've seen cases where somebody takes that $10,000 withdrawal out and they owe almost $5,000 of income tax. That's what I call a tax trap. And one of the things that I share with people approaching retirement is even if you've never worked with a tax and wealth advisor leading up to retirement, once you start to think about taking Social Security, I highly advise getting professional help, because you go from a 2-tax system, ordinary income and capital gain, to a 3-tax system, which is ordinary income, capital gain, and provisional income. And the stakes are a lot higher. And so that's one of the big areas that we help clients with, is just avoiding those tax traps.
It's one of the biggest issues that we see, but not only the tax trap, Dave, but this doesn't relate to taxes, but making that decision is kind of a one-time decision for Social Security. And we've seen people that have taken it early and they've lost out on several $100,000 of income over their lifetime because they didn't know how to do it better. And they started getting taxed higher by taking it earlier, because when you start taking your Social Security without knowing when it's going to be taxed, or if it's going to be taxed, or fully taxed, or partially taxed, you're missing out on any planning opportunities too. So that having someone that can go over your Social Security, what we do at Chamberlin is we do something called a Social Security optimization report to give you the information so that you can make that decision for yourself. We're educating you on what your options are so that you can pick it for your family. And then the tax ramifications of that too are included.
Exactly. And I think everybody needs that type of analysis. The fourth on our journey is allocating tax-sensitive assets. And, even when I meet with very sophisticated investors and they have a really, really great portfolio, in some cases, they don't have the right investments in the right accounts. And an example of that is there's certain investments you want to hold in an IRA, and there's certain investments you never want to hold in an IRA. There's certain investments you want to hold in a Roth account, and other investments you don't want to hold in your Roth account. And the same goes for the post-tax money. And so what I see so often is that even if somebody has the right portfolio for their goals and their objectives and their retirement needs, in many cases, they might not have the investments in the right accounts from a tax-sensitive asset allocation standpoint. In addition to that, there's many investments that carry tax preferences. For example, I see many individuals today that have a lot of money in money market or CDs because of the high interest rates we're getting, right? This interest rate hike, while it's hurt borrowers, it's been good for savers, but
Right.
they don't realize that interest income is taxed at your highest marginal rate, actually the highest marginal rate in the code for income generation because of the net investment income tax. And so sometimes by just reconstructing that, and maybe instead of owning a CD, you're going to own some high quality muni bonds, you
Right.
can increase your net after tax return. Because again, the one thing, if you get nothing else out of this episode, is that it's not what you make, it's about what you keep.
Correct. Correct. So one of the best examples of this that I like to share is that if you're creating income assets that are going to be more conservative and not grow as fast, those might be better suited for something that's going to have a less of a growth rate, right? Because you don't want to keep growing the tax deferred IRAs and 401ks as fast. You're better, and this is where we look at the tax funnels again, you're better having after-tax dollars in there or even Roth, because if you have Roth, the tax advantaged funnel, that's going to, if it has higher potential growth. Now, obviously, when we're talking investments, nothing's guaranteed because the markets are going up and down. But if you have potential for higher growth in Roth, that's where you would want the money to grow the most, the fastest, because it's growing tax-free, and cut down maybe on some of the growth potential for your IRAs and other tax-deferred assets.
100%. That's a great call out, Don. Just kind of carrying on our journey, number 5 is gifting strategy.
This is a fun journey, Dave.
This
This is
is a
great.
fun journey, isn't it? So again, like if you think about all the things that a Warren Buffett or a Jeff Bezos has done, yes, they have so much of their money in capital, right? That goes to
Correct.
tax sensitive asset allocation. They want capital because it's taxed more preferentially. But these are the things that their teams are doing. And gifting strategies is a big one because there's really 2 segments of gifting. There's charitable giving, which can really create a lot of great tax deductions if you have charitable intent. But there's also intra-family gifting. And for very high net worth or ultra high net worth families, this is so important in the environment we're in right now. But I want to go back to something you said earlier about like this concept of getting a retiree close to a 0% tax rate. Well, one of the ways that we can do that as a simple example is, let's say that you're giving $5,000 a year to your church. And right now you're just taking money from your retirement account and that's supporting your income. And then every month you're just chipping in some cash or you're writing a check to the church and you're taking the standard deduction on your tax return, which means you're getting no benefit for that charitable donation you're giving. Well, one easy thing to think about doing is what's known as a qualified charitable distribution if you're over age 70 and a half, which means you're essentially writing the church a check right from your IRA. And now that $5,000 doesn't even show up on your tax return. And so again, these were things that changed because of the 2017 Tax Cuts and Jobs Act. But
Right.
what I've seen is most people haven't changed their structure to be able to still take advantage of these things that are out there. And so
Right.
again, think
Right.
about like if somebody's bringing in 100 grand a year of retirement income, I mean, that's 5% reduction in their taxable income just because we're now diverting the money from the IRA directly to the charity instead of from the IRA into the client's bank account and then the client writing a check to the charity.
I know another thing that falls into this category is donor advised funds. So if you had a lot of extra income in a particular year, let's say you get a bonus or the year before you actually retire and you got salary and the next year you're not going to have salaries, what you could do is you could lump 2 or 3 or 4 or 5 years worth of those $5,000 deductions and put it into a donor advised fund and take that deduction in one single year and then just pay it out of that donor advised fund in the future years, $5,000 each year, as you need to pay that contribution. So that's another good way of doing this.
Yeah, and to accelerate that even further, Don, so many of your clients have highly appreciated stock right now. I mean, the market's been on a tear. Let's say your client was, had a little bit of stock in Tesla or Nvidia or Apple or pretty much any other
Or
tech
Bitcoin.
company out there, or Bitcoin, right? Those are the assets you can gift, because with gifting highly appreciated stock, you get a deduction based on the market value, not your basis, as long as it's a long-term capital gain. And so that's a really great thing to think about with gifting strategies. So again, these are all the things that an advisor can walk the client through as they go through this tax management journey.
Great, Dave.
Number 6 is pay now versus pay later. And I always chuckle at this one because I tell all my clients, you got to pay at some point, right? If you don't pay, you get to retire in an orange jumpsuit. And Don, you mentioned earlier, I'm an enrolled agent admitted to practice before the IRS. I could represent clients, but I never want to represent clients. Like, these are not tax evasion strategies. These are just thinking of the tax code like a game of chess. We want to be thinking 1, 2, 3 moves ahead to eliminate the avoidable taxes. And so pay now would be examples of accelerating income, doing Roth conversions, realizing long-term capital gains, selling assets. Pay later would be, how do we defer? These could be things like setting up and maxing out your 401k, your IRAs, maybe a cash balance retirement plan. These are the things that are going to defer income or not selling assets in a given year.
That's great insight. Thank you.
Yeah, and then you could get into really advanced strategies. Like, I've had some clients that have had a big liquidity event. Let's say they sell a bunch of stock this year, or their company gets bought out or something, and they're going to have really high income, but maybe they're going to buy a big house and they're going to need a really big cash deposit to do so. Maybe we want to borrow money this year in terms of like a securities backed line of credit.
Right.
And wait till next year to sell the asset and then pay off the loan. So there's so many unique ideas you can do when it comes to tax management, which brings me to stop number 7 on the journey: managing your dynamic bracket. Because if there's 2 things I do know, it's that life is uncertain and your personal financial situation is going to constantly change over time.
Right.
And the IRS tax code is going to constantly change over time. Every year, it seems to become more and more complex. There's thousands and thousands and thousands of pages of tax code, tax policy, new tax laws. Congress is continuing to meet to try to pass new tax reform. These things all impact your pocketbook. And so we need to make sure we're managing your dynamic brackets each and every year. Just like an investment portfolio, right? You want dynamic management of your investments to reduce risk and try to maximize return. You want dynamic management of your taxes to try to maximize income and reduce tax liability. And so there's so many unique ideas, strategies, and techniques, but it all starts with identifying your goals, your objectives, your resources, the order of money, and how all of these things can come together based on your financial situation.
That's great. So just to conclude, what would you say is the number one piece of advice you would give to someone who's looking to reduce taxes as they head into retirement? What really should they do as they head into retirement?
Yeah, well, I mean, I think obviously, I'm biased. You probably are too, Don, but it's working with a fiduciary who understands taxes. And the word fiduciary means somebody who has a legal obligation to act in your best interest. And it's somebody who understands retirement planning and taxes together. I know, Don, it's why we started working together almost 20 years ago, because we saw this need in the industry where people were getting siloed advice. Their CPA was not meeting with their financial or retirement planning advisor to coordinate. So I would say, if you're not very comfortable with this stuff, meet with an advisory team that can help you with it. If you are, you need to start mapping out, number one, your order of money, how you're going to think about starting to blend out tax efficient retirement distribution. Don, you mentioned the impact of Social Security. I can't stress that enough. It's such an important decision. Don't neglect the decision of how and when to take it, because it could cost your family an immense amount of money in either lost benefits or excess taxation. So those are some of the big points that I would stress on for anybody listening to this that's looking to get started.
Well, we so appreciate the information, Dave, and your advice about taxes. This is very valuable, I think, to the whole retirement community across the country. And we're fortunate to have you in our lives and be able to use this with all of our clients. The Tax Management Journey is actually a program that Dave put together. And he's teaching advisors all over the country how to use this roadmap. The planners that we have at the Chamberlin Group have been through this class. They know these items, and they're focused on helping you learn about them. We're educators primarily. We've educated way more people in this country than have ever become our clients. We're open to having you become our clients as well. You're going to have to find out a lot more about us first, but just know we're educators first. We're happy to educate you, get you to know these things, see if it fits for you or not. So to continue your journey, please subscribe to this podcast series, look up our YouTube channel, and there's a button below that you can push to get started right away if you'd like to have a phone call with one of our planners and educators on how these different things can fit into your retirement plan as you go forward, particularly with taxes like Dave's mentioned. So until next time on the Retirement Planner Podcast, so long, and thanks so much, Dave. Really appreciate you very much.